It's Friday, 13th of December, and this is your Capital Economics Weekly Briefing. I'm David Wilder. Coming up, our big financial market calls for 2025. But first, Group Chief Economist Neil Shearing joins me to read over the chicken bones of another week in macro and markets and see what the future holds. How's it going, Neil?
Hi, David. All good. How are you?
Yeah, good. Getting ready for the end of the year. But before that, we've got big central bank meetings, the last ones of 2024. We've just had the ECB, growth concerns there, trumping any lingering worries about inflation. We've got the Fed this coming Wednesday, their statement. Some think inflation is a reason not to move at the coming week's meeting. And the Bank of England, where growth is looking weak. We had that GDP data just a few hours earlier before recording this, Friday morning London time. Perhaps not enough to push them to move at this upcoming December meeting and cut again, though. So putting all of this together, these grapples with policy dilemmas, do they get any easier for these banks in 2025?
Well, I think one of the striking things is, and you alluded to it just then, is that each of the major central banks, the Fed, the ECB, the Bank of England, they're grappling with slightly different issues. In the US, it's the apparent strength of inflation in some of the recent numbers. I'll come back to that. In the Eurozone, it's the absence of growth. In the UK, it's a bit of everything, really. We've had an economy that's grown 1 month out of the last 5. If you look at the monthly GDP numbers, the activity data looking pretty tepid, it has to be said, but some lingering concerns about the tightness of the labour market. Set against that, the labour market data in the UK, there's huge concerns over its validity and some problems with response rates that means it's quite difficult to get a read on what's happening to the UK labour market. So different central banks grappling with different challenges. Now, what does that mean? In the US, the principal concern, I think, has been some of the upward surprises to the CPI numbers in recent months. But if you look at the Fed's preferred measure of inflation, the core PCE numbers, I think that's going to be a lot weaker, substantially weaker in November. So we think that taking the PPI numbers that were released over the past week, the core PCE index may be flat on the month in November. That's right, flat. So no increase at all month on month. And if that's the case, I think that gives a green light to the Fed to cut again in December. The ECB obviously cut by 25 basis points. The question is, to what extent are they going to follow that up with further cuts in 2025? Might they throw in a 50 basis points cut? The market took the ECB meeting as a bit hawkish. We've seen yields back up a little after the meeting. But our reading actually is that there's quite a lot there for the doves, in particular an acknowledgement of the challenging growth outlook. And we're penciling in a fall in ECB rates all the way to 1.5% over the course of next year. And then the Bank of England, they're sitting on their hands. I don't suspect they'll move in December. But there are signs that the economy is struggling. It may just be flat. GDP may be flat on the quarter in Q4, growth of 1.5%, something like that next year, which would be better than this year, but it's not particularly great. So I think the Bank of England is going to have to get a hurry on and start removing some policy restriction at some point pretty soon. And I suspect that rates will start to come down pretty early on in Q1.
So in terms of the three banks, which do you think are perhaps most at risk? You talk about upside inflation risks in the US, you talk about downside growth risks in Europe and the UK. Of these three, where are risks greatest in 25?
I think it's tempting to say the risks are greatest in the US because the policy backdrop's most uncertain. President Trump taking office in January, it's still unclear exactly what the policy agenda will look like. To what extent will tariffs be increased? To what extent might there be some discretionary fiscal stimulus? How might the regulatory environment affect the supply side of the US economy? There's all manner of uncertainty there. Now, we've taken a view that some of this is a little overdone, in particular the idea that we'll get large-scale discretionary fiscal stimulus. But it's possible that we're wrong on that. And we could, of course, get more aggressive tariff increases than we've penciled in, or we could get a much bigger offset in terms of a stronger dollar. So I think for the Fed, the outlook is particularly uncertain. The terrain is particularly uncertain. However, I think you can also make the case that it's pretty unclear in Europe too. I've already mentioned that the data in the UK is a major issue for the Bank of England, just getting a handle on the health of the labour market in the UK is quite difficult. And in the Eurozone, we've got not just the threat of Trump tariffs, but what's happening in China. It's obviously a major export market for Germany. We've got difficulties in assembling a government and therefore passing the budget in France. And of course, elections in Germany next year. So there's uncertainty every which way you look. I don't think it's right just to say those risks are greatest in the US because of Trump. I think you can make the case actually that in Europe, they're arguably even greater.
I want to move on to China because past week we've had a Politburo meeting and the Central Economic Work Conference, and that meeting is a big government get-together to outline plans for the coming year. We don't get a huge amount of detail in terms of policy from either, but the communications that have come out do speak to this sort of shift in the policy stance that began a few months ago. Looks to be continuing into 2025. We've had a formal change in the language around the monetary policy stance back to a stance that was last seen in the global financial crisis. Now, putting it all together, we have been pretty dismissive of efforts so far to turn the Chinese economy around. Is there a risk that we're being too downbeat?
There's always a risk, isn't there? It's difficult enough working out the direction of policy in advanced economies in the US and in Europe. It's even more of a black box when it comes to China. But I think that's perhaps even more of a reason not to take some of these statements at face value. So what's the government said? We know from the official communications that monetary policy is going to shift from being prudent to moderately loose. As you say, the last time we had that was in November 2008. But of course, the economy and the global economy in a very different position back then. And that fiscal policy will be directed to, quote, vigorously boost consumption. And the subsequent readout from that meeting suggested that it would be focused on boosting household consumption, which is important given that that's the major shift that the Chinese economy requires. However, I still think there's a danger in over-interpreting some of these statements. There's a triumph of hope over experience in some parts of the markets, I think, going on here. If you think about monetary policy, we've now penciled in 50 basis points of cuts in the official rate next year, some cuts to the reserve requirement ratio too. Taken together, that would be the largest cuts to interest rates and reserve requirements since 2015. But it's not obvious to us that what's holding back credit growth in China's economy is a kind of lack of supply of credit, the cost of credit. It's just a lack of demand because of debt overhangs, problems in the property sector, and so on and so forth. So rate cuts potentially, monetary loosening potentially a bit less effective in terms of supporting the overall economy today. And then on the fiscal side, that means that the fiscal expansion and fiscal support is even more important, but we don't have much in the way of flesh on the bones of these plans. We think that the deficit may increase by about 1% of GDP next year. The readout from the Central Economic Work Conference that you mentioned suggested that some of the policies might be aimed at lifting pension payouts, lifting payouts and medical insurance too. And that would all be a step in the right direction, but we don't yet have much in the way of detail. And in the meantime, I think it's really important to note, to bear in mind where China's economy is coming from. We're starting from a position where this year, the share of fiscal spending accounted for by public investment is going to be at its highest level since 1987. So we're starting from an extreme position in terms of fiscal policy being directed towards investment. So just some rebalancing towards consumption will be a step in the right direction, but it's got to go a long way to make a meaningful difference.
Yeah, so a lot of the communications, a lot of the policy signaling has been about throwing more money at the economy to try to deliver this short-term boost. But the fundamental reforms, the measures to address the structural issues that we think are going to drag growth lower, no sign really there of any appetite for these sort of root and branch changes that are needed.
Yes, and it's possible we get them. We're not saying it's always possible, but I think the starting point is so extreme, the scale of the shift is going to have to be pretty enormous to make a meaningful difference.
Okay, I'm jumping around because a lot's been happening and I'm conscious of time, but I do want to just touch on a very different issue, which is what's been happening in Syria. It's very much a geopolitical story, but I think it's one that speaks to what you've been saying about how much geopolitics will or won't drive the macro narrative going into 25. One thing that strikes me is just how much of what's happened speaks to unintended consequences. I think there's analysts out there saying that they'd predicted Hamas's attack on Israel last October, but I'm pretty sure no one thought on the 7th of October that what happened would lead to the end of Assad rule in Syria. And obviously, no one really knows where this is going to go. But how do we frame this in terms of what it means for the macroeconomic outlook? You've got these major powers involved. You've got the US, you've got Russia, you've got Turkey involved in Syria. The map of the region is clearly being redrawn. From a macro standpoint, what are the key takeaways here?
Well, I think one point that's perhaps not macro, but geopolitical in nature is that a lot of these events are interlinked. So there was Hamas's attack on Israel and then Israel's response to that, which obviously drew in Iran. That's had a bearing on what's happened in Syria, but also, of course, the war in Ukraine and Russia's support for Syria perhaps being diminished because of that war. So a lot of these events are interrelated. It's interesting, too, that countries like Turkey play an increasingly important role in mediating some of these issues, too. So there's lots of geopolitical implications and consequences. But in terms of the economics, I think, frankly, it doesn't really move the dial. Now, it's possible that it might do if it were to seriously affect the flow of energy in particular, oil shipments and gas shipments in particular. But that doesn't look likely at this stage. And that comes back to a point that we've talked about before on this podcast, which is that geopolitics, I think, really is starting to matter. Now, having been quiet for the last kind of 20, 30 years, geopolitics is suddenly a really important issue in the global economy, but it doesn't move the macro dial from one quarter to the next unless it's a really extreme event. I think that's something that's going to be important to keep in mind as we go through 2025, because we're going to get more of these types of events. They're going to come from left field. We've talked about just now. Policy environment in the US and in Europe is increasingly uncertain. The same can be said in China and in Asia too. So I'm sure we'll get more of these types of events, but just a bit of caution about overreading in terms of what it means for the near-term macro outlook.
Okay, let's stay on 25. Let's stay on this idea of risks to the outlook, because I know you've been drafting your list of what could go wrong with our forecast in the coming year for clients. And I like it because it does end on an upbeat note. It's always nice to end these things on an optimistic note, because we tend to think of risks as a negative, but there can be upside surprises, right?
Yes, of course there can be. And I think one of the points when it comes to people writing notes about risks in the year ahead, sometimes they degenerate into a laundry list of what could go wrong. So it becomes like a get out of jail free card for analysts. Here's our central forecast, but here's a long list of things that could go wrong that would upset those forecasts. There's always that could go wrong, and that people never really think about what might go right, and that there will be upside risks. And of course, there's lots that could go wrong next year. So rather than just providing a long list of things that could go wrong, what we're trying to do is think through not just the probabilities or possibilities of those events developing, but what would the consequences be? And in particular, what might the triggers be so that clients can get an early read on whether some of these risks are starting to materialize. And yeah, there's lots that could go wrong, but there are things that could go right too. We've talked a bit about China. We've been a bit skeptical on the idea that there'll be large-scale stimulus and that will really move the dial next year, but we could be wrong on that. It could be the case that we get much larger fiscal support, and that's directed at households in particular, and that would make a meaningful difference. I think there's a sense too in which the growth stars could potentially align next year. The US aside, where we think inflation will tick up because of higher tariffs, I think elsewhere in the global economy, underlying inflation pressures will continue to trend a bit lower. That will give some support to real incomes. We've not yet seen much by way of a response to bank lending, to interest rate cuts by central banks so far, but I think that could come next year potentially. And all of that would help to support demand in economies. But then on the supply side, given economies at full employment, we need to get some productivity response. And of course, we've had some of that in the US already over the past year. It's possible that we get a similar pickup in productivity growth in other economies across the world. Like I say, this is not our central forecast, but I think it's just a useful counterweight to some of the pessimism that we're seeing in some quarters of the market. It's possible that growth could pick up a bit next year, and that maybe in 12 months' time, we're sat here looking at a global economy that's been a bit more resilient and has performed a bit better than people currently anticipate.
Neil Shearing there on central banks, China's policy pivot, geopolitics and the macro narrative, and risks to our 2025 view. His note about risks will be out on Monday. It's a companion to his previous 5 for 25 on the key macro themes for the coming year. If you want more focused analysis on countries, regions, and markets, I'll point you to our Outlooks page, which gathers all of our latest quarterly look-aheads, link on the podcast page. On those central bank meetings, we're holding a drop-in. That's one of our short-form online briefings this coming Thursday at 10 a.m. New York, 3 o'clock London, just after the Bank of England meeting. The Economist team will be answering your questions about the MPC, the Fed, the ECB December decisions. They might also have something to say about the Bank of Japan, which meets that morning. We're forecasting another rate hike there. There's a load of data releases in the coming week as well, which we will be responding to with instant insight and longer form updates as usual. Some highlights include Chinese retail sales, IP, and investment on Monday. That's for November. The latest UK employment and inflation numbers on Tuesday and Wednesday. And US income and spending data, those PCE numbers that Neil mentioned, those will be out on Friday. Our week ahead calendar has more details on what releases you should be watching and what to expect from them. I will add that to the podcast notes too. Now, the S&P 500 hit our long-standing end 2024 target of 6,000 in recent weeks, and market expectations for end 2025 are being raised up towards our 7,000 call. But what we're seeing is a bubble that's inflating in US stocks. There's an incoming president with a big axe to grind with US trading partners, and as Neil explained, there's concern in some corners of the market and among policymakers that the inflation genie isn't getting back into the bottle. What does this all mean for the financial markets outlook in the coming year? Well, following on from last week's episode all about the big macro themes for 2025, I spoke to John Higgins, our Chief Markets Economist, about what will drive stocks, bonds, and currencies in the coming year. And here's that conversation now.
To the podcast.
Hi, David.
Soon after Donald Trump's victory back in November, we tweaked a load of our forecasts, including nudging up our Treasury yield view and building a stronger dollar into our assumptions. But our end 2025 S&P forecast, that was 7,000. That had been in place for about 6 months, and you left that unchanged. What was the reasoning behind that?
The reasoning behind that was that we still feel that the case is strong for a bubble in AI to continue to inflate next year, and that's likely to result in some further significant gains in the stock market. You may remember back in the sort of summer of last year, we did an extensive body of work, Capital Economics, on the subject of artificial intelligence. And one of our conclusions at that point was that AI would become this transformative technology, the benefits of which would crystallize pretty quickly in equity prices, even if they diffuse only slowly through the economy. And that's really when we began to adopt a very upbeat view about the prospects for the S&P 500. Along the way, we have actually nudged up our forecast, but the overall narrative hasn't really changed. And it really revolves around two things. One is a sort of judgment that the valuation of the market is going to go up and reach the sorts of levels we saw at the peak of the dot-com boom. And the second one is that we're going to see some strong growth in underlying corporate earnings, and in particular, the big tech sectors leading the way there. And if we look at what's really happened since we made that call, it's largely played out in the way that we had anticipated. And we are sticking to the view that we've got more upside to come, really, in the S&P 500. If you were to look at its valuation, for example, whilst it has gone up, it's still shy of the level that it reached at the peak of the dot-com bubble, which is implicit in our forecast for where it'll get to at the end of next year. That's a price-earnings ratio of 25. And similarly, we've had a pretty upbeat view about the way earnings are going to evolve. We've had to upgrade that along the way, and we don't really see reason to change that. Admittedly, we've got a sort of view that Trump's policies are potentially a net negative for growth in the US, but we're not envisaging a recession, for example, that might really undermine the outlook for earnings in the US or in the big tech sectors, for example. There are other challenges there, of course, to the earnings outlook. But our overall judgment is that we're on track here for the stock market, as I said, to continue to make strong gains into next year.
So all the talk about Trump coming into office with a plan to raise tariffs across the board, all the speculation about heightened trade tensions in 2025. What's going on with the stock market? What you're saying is actually this AI narrative means that it's somewhat insulated from all of that.
Yeah, I think if we were to look at or list a bunch of things that could potentially cause things to go awry in terms of our forecast for the stock market to make more gains next year, I think trade tensions would probably be on that list, but there are others. I've already mentioned, for example, the more general outlook for the economy. And whilst we do think Trump's policy of potentially implementing significant tariffs would be a net negative for growth, we don't envisage it resulting in a recession, for example, in the US. So we're not really of the view that we're going to see a big drag on earnings from the economy at large performing much more softly than we're envisaging. Of course, you could make the case that earnings in the big tech sectors themselves might come under pressure regardless, actually, of how the broader economy does. And of course, the risk there is that actually the demand for AI turns out to be not as strong as we and others are envisaging. In which case the strength of growth in earnings that we have been seeing over the last year would presumably end and possibly unwind. But again, it's not obvious to us when we look at the data that that there is evidence of demand for AI softening at this point. If anything, it's been strengthening. Of course, there are other risks as well, and these are connected, I guess, to Trump's policy agenda. One would be a big rise in bond yields, bigger than the one we're anticipating. If, for example, investors took fright at some of Trump's policies, for example, if they viewed his plans for tariffs and immigration curbs as being particularly inflationary. Again, not a lot of evidence, I think, for that. And of course, there's been a lot of talk about a major fiscal expansion again in Trump's second term, but that's not something, again, that we're envisaging. We do think potentially that the tax cuts that would otherwise sunset will be rolled over, but we're not envisaging a fresh new major deficit finance fiscal expansion that would result in potentially significantly higher bond yields. And even if we did get the sort of bond vigilantes coming out and pushing bond yields up a little bit amid concerns that we were going to get that sort of policy outcome, I think that could well be a sort of self-correcting mechanism in a sense, and that lawmakers probably be all the more inclined to push back against accepting another big stimulus if they saw that sort of pressure coming from market forces. I don't think that's a major risk to our outlook for the equity market either. And then just a couple of other points perhaps where it's worth being a little bit cautious. One, of course, is the possibility of big tech being broken up and what that might do. Again, that's possible. We see lots of connected stories to that in the media. I'm not sure it's much more likely under a Trump administration than it has been under a Biden one. And even if it happened, I'm not sure it really undermines the broader AI narrative, because you might get some losers, but you might get some winners. But the big picture, I think, is that the AI narrative potentially would remain intact so long as demand for AI itself is remaining pretty strong. And then the final one really is whether China could spoil the party insofar as it might retaliate in ways against the imposition of tariffs by the US that could potentially put a spanner in the works. For example, it could make it harder for big tech to operate within its territory. We've already seen over the past week or so some suggestions of that. By and large, we think China will want to be seen as the responsible superpower and not engage in activities like that that would undermine that reputation that it's trying to establish. In any case, some of these big tech companies are pretty well enmeshed in China's economy, and it is a beneficiary of having that, in the sense that it can learn quite a bit from some of these companies, particularly at a time when the US is clamping down on the sort of export of high-tech knowledge to China. So we doubt that China would retaliate in those sorts of ways. Of course, there's also a risk that China becomes more bellicose towards Taiwan, perhaps misinterprets what the US is signaling about its commitment to defend Taiwan. But again, that's more of a black swan event that doesn't feature in our baseline forecast for what might happen.
It's a very US-centric story that we've been telling here, but on a relative basis, looking at 2025, does the US stock market remain exceptional? in terms of delivering returns?
That's our expectation. Obviously, US exceptionalism has been a feature for much of the last decade or so, and arguably all the way back really since the GFC ended. And if you think about how the AI narrative is connected to the outlook for the US vis-a-vis other stock markets, I think it's generally one that should reinforce that US exceptionalism insofar as tech sectors are more heavily represented in the US stock market than they are typically in other markets, to the extent that we see continued enthusiasm for AI driving stock markets higher. It stands to reason in our view that the US will probably benefit the most from that. And then, of course, when it comes to the risks around Trump's policies, we only have to look back really at 2018 to see how that interacted with a period of US exceptionalism. So, if 2018 is a useful guide, what we saw then was a significant underperformance of equities in the rest of the world vis-a-vis those in the US. And that was particularly pronounced actually in common currency terms, reflecting the appreciation of the dollar we saw at that time. Obviously, it's far from certain that we'll see history repeat itself in the same sort of ways, but nonetheless, I think the prospect of another trade war does lend itself to the view, or reinforces the view, if you like, that we have of the US continuing to outperform other markets next year.
You mentioned the dollar. Before you go, I just wanted to check in because obviously Trump has spoken about his desire for a weaker dollar. He's got quite the opposite since winning the election. What do you see happening over 2025 in terms of that push and pull between what the president-elect wants and what his policies deliver?
Yeah, I think those things aren't necessarily mutually compatible, are they? It's all very well to want a weaker dollar and for the US to be more competitive in international markets, but some of the policies that he's looking at implementing potentially would have the opposite effect, not least the imposition of tariffs, which tend to result in appreciation of the currency of the country that's imposing those tariffs. As I just mentioned, we saw that in 2018, and that's a feature of our forecasts for next year, that the dollar on net is likely to benefit from a trade war as currency markets adjust. Above and beyond that, of course, there's a whole question of how do Trump's policies affect the prospects for relative interest rates in the US and elsewhere. And that's important because relative interest rates in the US and elsewhere tend to have a big bearing on short-term movements in the dollar's value against other currencies, in a very tight relationship, for example, of late there. And I think while we're not expecting a major deficit financed fiscal expansion in the US that would result in the Fed, for example, ceasing its easing cycle or indeed reversing it, we do think that in general, interest rate differentials will shift a little bit in favor of the US over the coming 12 months. And that's largely because we see policy being eased a little bit more substantially, at least relative to market expectations elsewhere. In general, there are one or two exceptions like Japan, where we actually think monetary policy will be tightened more than the markets are anticipating. But the bigger picture, I think, is that on average, we see interest rate differentials, as I say, shifting a little bit in favor of the dollar. And above and beyond that, as I mentioned, the trade war perhaps providing the greenback with a further boost.
That was John Higgins on the market's outlook for 2025. There was a lot more ground to cover, but this is meant to be a bite-sized weekly podcast. I do hope to have John back on soon, though, so he can get more into the weeds about this market bubble, what's driving it, and what the end game looks like. In the meantime, his team's outlook reports will be out in the coming days, so do keep an eye out for those. But that's it for this week. We're back next week with more on macro and markets as 2024 winds down. Until then, goodbye.
Whilst this podcast is provided with all reasonable skill and care, it comprises the subjective views of our economists. Furthermore, these views are not opinions, nor do they constitute investment or financial advice, or are they guarantees or reassurances to the expected results of any investment products or outcome. You should seek your own specific advice in relation to questions you may have. We will have no liability to you in relation to this podcast whatsoever.